Hey, what's up guys, welcome back to the channel. So today I'm going to be talking to you about two different types of ways that you can get invested in different funds. So that's an index fund and a mutual fund. So an index fund is a collection of stocks that are constructed to closely follow a market index. So whether that's the Dow Jones or the S&P 500 index, they follow their target regardless of how the market performs. And essentially the index fund gives you a standardized risk level. And then you've got the other option, which is a mutual fund. So a mutual fund is a selection of stocks chosen by a fund manager, which are essentially made up of a pool of money from multiple different investors to allow you to diversify your funds. So they could be more targeted, so you can select often which stocks you put in there, but typically it will be recommended by the fund manager what you should have in each one of your funds. So the advantages of an index fund is that it's a completely passive investment. You don't have to actively manage which stocks you're putting in. You don't have to evaluate a company's performance to choose stocks. You also get dividend payouts for certain stocks which are inside the portfolio. And it's automated, so it's completely without a manager. You just put your money in and basically a computer algorithm will assign your money to the index fund that it's tracking. So for that, there's incredibly low commission and charges. So for example, the Vanguard S&P 500 index has a 0.07% charge. So they're also really good for a long-term kind of moderate risk investment. So the S&P 500, for example, has consistent returns over a 10 to 30 year period. So over the last 30 years, the S&P 500 has actually averaged an annual return of 9.8%. The other thing that you get, which is a massive advantage of these funds, is that you get really good diversification for really low investment. So you can start an index fund, for example, the Vanguard S&P fund, with as little as £500, but that exposes you to just over 500 different companies and allows you to buy a small amount of shares for each one of them. Now, there are of course some disadvantages to things like index funds. So for example, there's really low reactive ability. So if the market changes very quickly or if it drops very quickly, it's quite hard to react to that. And for example, if you were investing in individual stocks and a certain stock dropped massively, but was then going to recover, you could react by buying that stock. Whereas when it comes to an index fund, you're very much at the openness to the market. So if the market drops, your fund will drop. That's hand in hand really with the lack of downside protection. So because the index fund will track the index, no matter how the index performs, if the index drops, your fund will drop. And finally, you don't have any control over a fund such as an index fund. So it's really, you just pick a fund that you want to invest in, you put your money in, and a computer does all the work for you. Now, you don't get the buzz or the satisfaction of picking that stock that then goes on to perform fantastically, but at the same time, you also don't have the number of man hours it takes to find that correct stock, that perfect stock that might just work for you. So then the other thing you've got is a mutual fund. Now, the advantages of the mutual fund is that you get a professional portfolio manager for a very low cost. You also again have dividend payouts on stocks which are made up inside that mutual fund. And you can more selectively tailor the risk level of a mutual fund. So you can pick either more risky stocks or less risky stocks, or a combination of stocks that kind of adds that diversification without the really low or really high risk that you might have from picking individual stocks. You also have a relatively low initial investment. Now, for the most part, this tends to be slightly higher than an index fund, but it's not significantly higher. You're talking maybe £1,500 to £2,000 to start one of these funds. You also get a really good level of diversification, and you can choose how diverse you want to be. So whereas an index fund, for example, the S&P 500 is matching 500 companies, you could make a mutual fund to match maybe 15 or 20 companies. So essentially, a mutual fund is a more tailored way of investing than an index fund, because you can select a few more things. There's a few more variables that you have to play with. Now, of course, these come with downsides. So because you have a professional portfolio manager, you're going to be paying an increase in commission. So an index fund like the Vanguard S&P, you're paying 0.07% charge. On a mutual fund, you can typically pay between 1% to 2% and even upwards of 2% charges. You also have slow execution times, so mutual funds are only traded once per day, which means that you can't take advantage of very sudden drops and rises in the market within the same day. And then of course, there's less control. It's the same as the index fund. You don't have control of picking the stocks yourself and individually investing in them yourself. Now sure, in certain mutual funds you can suggest stocks that you want to be included in there, but typically you won't be able to just pick and choose exactly which stocks you want in there. And so that can kind of reduce that satisfaction that you get and the sense of control that you have. So there are kind of some really interesting stats to bear in mind. So a mutual fund manager, for example, what they're trying to do is diversify your funds to beat the market. So that's why the charges are higher, because the potential reward is higher, because what they're trying to do is not just match an index, but beat an index. So the only issue with that is, of course, that you're then at the liability of how successful the fund manager is at picking those stocks to beat the market. And typically, it may not be as cut and dry as just because they're a professional or something, they know exactly what they're doing. So, for example, Burton Malkiel, a Princeton University professor, back in 1964 suggested that if you got 100 trained monkeys who could throw darts, and you stuck the newspaper sheets with all of the stocks on there, and you got them to throw 100 darts and pick 100 stocks to make up a portfolio, that they would likely match the index. Now, of course, that's not what happened. They selected, there are 100 stocks randomly, and actually, they have beaten the index by an average of 1.7% per year since 1964. So these stock-picking monkeys technically beat Wall Street. And in fact, 98 out of 100 of the monkeys beat the market averaged index on their very first try. So just because you have a professional picking your stocks for you doesn't necessarily mean that they're going to beat the market, and doesn't necessarily mean that you might not be better off with some darts throwing monkeys. And then if you compare this, for example, to investing in an index fund. Now obviously this isn't exactly the same because we're not talking about monkeys versus professionals, but we are talking about Donald Trump, so it's not far off. Donald Trump, back in 1987, had a real estate investment portfolio of around $500 million. Now, at this point in time in 2020, Donald Trump's net worth is around $2.1 billion. So he's done pretty well for himself. He's, made a pretty categoric return on that initial amount that he had. And you'd say, by any stretch of the imagination, you may not like the guy, but he's a success story. Now, if you go back to 1987 and you take that 500 million that Donald Trump has, and instead of continuing with real estate and his different businesses and whatever, and you just took that money and you stuck it all in the S&P 500 index fund, well then today, Donald Trump would be worth around about $12.4 billion. So that's 6 times more than his current value. So that kind of shows the power of an index fund. And in fact, the power of an index fund is time. So when you put your money into an index fund, the return is on the amount in the index fund each year. It's a compound interest. So if you have that initial amount in there, sure, the interest in the first few years, you might be better off investing in a mutual fund or starting up a real estate portfolio. But actually, over time, over 10, 15, 20 years, then the compound interest effect is what puts an index fund streaks ahead of everything else. Now, this is all, of course, just my own personal advice and opinion, and you're welcome to do whatever you want. You may go for index funds, you may go for mutual funds, you could go for real estate, you could trade your own individual stocks and become a day trader. But in my opinion, I think to myself, why would I risk the extra 1 to 2% charge for a mutual fund when a fund manager may not even be able to beat the market, and they'd need to beat the market by a minimum of 2% to warrant the extra charge that they commission? And for example, the S&P 500 and the Dow Jones index, they've both performed incredibly well over long periods of time and have returned very good profits. In the last 15 years, the S&P 500 index has over a 5% return a year, and the Dow Jones has over a 7% return per year. So yes, the idea of a mutual fund or picking your own stocks sounds fantastic because it could be a get-rich-quick scheme. But the truth of the matter is that get-rich-quick comes with a lot of risk, whereas get-rich-slow actually works. So the whole thing is, really, it boils down to your appetite for risk. So it's all about whether you're willing to put that extra amount of money behind the mutual fund which obviously is the increased initial investment and the extra charges that you might be charged due to your fund manager. But the potential reward being that you could more quickly see gains and you could obviously more quickly get to that retirement point. Now, my opinion, I'm going to stick with using index funds, and then if I want to have that kind of gratification of picking your own stocks and finding your own benefits, then I'd rather trade with Trading 212 and not pay the commission to a fund manager. And if that's something that sounds interesting to you, then you can research stocks for investing in Trading 212. If you watched my last video, I went through a quick breakdown of how to find a good stock to invest in. And if that's what you want, then open a Trading 212 account using the referral link down in the description, and you can start off by getting a free stock worth up to £100. So that's pretty much it. That's my advice for today's video. And if you liked it, please like and subscribe. And of course, let me know in the comments section anything you want me to change up or anything that you have suggested for another video in the future. And I'll catch you in the next video.